Hi everyone, welcome to Boothy's Bites. Boothy! Well, it didn't take long for February to get interesting. Big start to the year, right?
Yeah, crazy. And here's me with my little, my little globe. Can I see? Can I see? But got it completely wrong, Jackie. And I think just Jackie got it completely wrong because I told you to say that too. So I've let everyone down, which is a big shame. So anyway, 25 basis points higher the interest rates, and pretty much everyone increased by 25%. 25 basis points pretty quickly. So yeah, 3.85% is the cash rate.
Yes. Now, being this time of year, we're seeing lots of reviews and strategy planning with clients. What are you seeing clients wanting to focus on as they plan for property and lending needs in 2026?
So, firstly, most clients who've got property, even though it's a slow fixed asset and we've not got pricing sort of daily on it like the share markets, they love to see the value of their property. Right? It's a big barbecue conversation. So one of the first things that we do is we prepare a RP data report or evaluation report online, and we just share what the statistics are, one, regarding their property, but two, what's happening in the property market more locally and geographically in their area, right? And that's interesting because even though these people aren't looking to sell their property or do anything, number one, it's looking at what equity potentially they've got in their property. Number two, it's a real feel-good conversation saying, you've picked the right property in the right suburb and it's making you lots of money. And three, for some, aspirationally, they can use the equity there to go and get that next property as well. But I think it's a good thing to review the value of that asset in particular. The second part of that is cash flow. If you've got an investment property, obviously you're getting rent income for that, and there's no doubt about it, the cost of managing that property has increased, and the demand for your property from a rental perspective has massively increased, right? So there is a big shortage out there of rental properties. And look, I've gone through the similar sort of conversation with my landlord just recently, who, we're renting a place in Randwick, and they've increased the rent on my property. And there's no doubt about it. The reason they're doing it is, one, there's a high demand in the area. Two, the value of the asset has appreciated. Three, their personal cost to manage that property has gone up. And fourthly, it's an annual review right now for property rent as well. So, again, check in with your broker. We can do the reports regarding valuation on the property, rent appropriate to that property. And what that might mean is that you need to freshen up the property to maximize the rent and the return on that property as well. So, a bit of strategy around the property. Obviously, we're always going to look at interest rates, where they're sat. This increase at 25 basis points, most banks and lenders have passed that on. So, but again, looking at what is a good rate right now is important, and also looking at what opportunities from a servicing and borrowing capacity is out there too.
Yeah, absolutely. Now, just back to that 25 basis point increase, what's your read on that decision and the reasoning behind it?
Well, the inflation figure has certainly not helped, right? And the RBA are looking retrospectively at data which is collected, 2 or 3 months in arrears, really. So, for me, that it's just a bit of a blinkered view on, what the RBA needs to do for the economy. Inflation is one part of it, and yes, I understand we need to call that, but there's a lot of elements which go into inflation which are sort of out of the control of that cash rate component. Okay, and I'm probably being a little bit conflicting in what I'm saying compared to what the economists would like us to do from a traditional sense, but certainly the economy and the people in the economy right now and the fuel in that inflation figure is very difficult to contain purely by increasing or decreasing interest rates. So the RBA, just with this single lever, I feel they're in a tough position. The things I really look at is how we've drifted as an economy over the last few years. Our forecast for growth in this economy in the next 12 months is not great. I think we're looking at a forecast growth of GDP at around about 1.6%, which is well and truly below the mean. And if you add inflation at over 3% on that, for the average people, it means we're going backwards, right? Incomes right now have been stifled for many years. The bonuses and things like that are definitely not in the economy, and employment is actually quite hard for younger people trying to get right now. So that's tough, So there's elements in our economy that really need a boost, and just purely by looking at inflation and tightening that component is really not looking at the growth of the economy. It's not looking at how we can create more jobs for young people in society. So yeah, look, I think there's probably a a scope to talk about really what the true purpose and the elements of measurement for the RBA is, and how they can get some help from the government as well. And that sort of throws in another conversation, being the Labour government are talking about taxing property, right? So maybe some death tax and maybe some capital gains tax on property for property investors. I just think it's again an element which needs to be looked at, but in isolation, it's just, you know, it's taxing more wealthy people. It's actually not getting rid of the fundamental problems of our housing problem, where there's not enough stock, there's not enough properties being built today, there's a lot of vacated properties, okay, for wrong or right reasons, and migration over the last sort of 10 years has overtaken the availability of property in our economy. So we've just got to be a little bit more strategic in how many people that we are recruiting for the Australian lifestyle. Where are they going to work? Where are they going to live? And is it affordable to give them a quality of life that everyone wants when they come to Australia? So I think in summary, there's a lot more involved in sort of where we're at as a country right now, not just this RBA rate hike. But my gut feel is the next 12 months now, I'm going no more rate cuts, yeah?
We love to hear it. Now, you just spoke to one of the themes now, but there's a few others that you've mentioned previously, like the housing, taxation, energy, AI, all those themes. How do you think those themes are influencing the way you're thinking about lending and strategy right now?
I think technology for us as a professional services business is key. We want our clients to have quick turnaround times, quick access to information, and quick settlements with the right lenders who are also digitizing. So we've engaged. Well, we're investing in technology. We're looking at automation as a value and a benefit to our broker team. It's allowing them to have better relationships with clients and turning around that data much quicker. Yeah. The second part of it is for a lot of these digital lenders or quick lenders, we're getting settlements in a week these days, right? Which is kind of crazy. In the old days, if you did an application, it'd be 4 weeks minimum, 6 weeks as an average, right? So I think in the next 12 months, with this digitization and technology advances we're all getting, we can start to expect that sort of application approval settlement period really contracting, yeah. And the only restricting part of the application these days to settle on a property is the conveyance. So these days when we exchange on a property, we've got 6 weeks to settle. That's what the conveyancing environment gives us, which in this new credit environment, we actually shouldn't have to wait 6 weeks. We can actually probably do it in 4 or 2. So I think that's something which is coming to us in the next couple of years. So anyway, that's going to be interesting.
It will be, that's for sure. And so I think it's maybe the generation of the comeback of the cashback, right? The comeback of the cashback. Remember a couple of years back when everyone was offering cashbacks for refinancing? So they could be returning. Is that right?
I think so. Well, look, it's funny. So, as a feeling I get, there's not as many purchases in the market right now. The work we're doing is a bit of a refinancing, but the contraction of the premium rates is quite close. So the amount of genuine opportunities to help a client borrow and change contracts and change lenders in the system right now is a lot less than it potentially was a couple of years ago. The property market, especially in that $1 to $1.5 million place, is super tight, not enough stock and not enough transactions. What's that meaning? Well, the big businesses which are geared up to do X amount of volume, they need to attract deals. And one of the ways that they've done that in the past, which I think they'll start to get that back, is enticing clients to come back with a cashback offer, so a heavily discounted rate, some cashback to smooth out the change of lenders, and generally attract clients to bigger national brands, right, which is carry some heavier costs. Yeah.
Definitely. Yeah. And so what's the latest lender rates looking, or how are the latest lender rates looking? And how should borrowers be thinking about fixed rate versus variable at this moment?
So variable rates right now, so we've got pretty much 5.25% is sort of our median rates for good borrowers, and that's low loan to value ratio, principal and interest, owner-occ properties. Macquarie Bank have got a great rate at 5.34, and we just talked about that technology and turnaround times, and they offer that amazing service on stuff there. But the fixed rates, they haven't moved as quickly potentially as the variable rates have, yeah. So what we're seeing there, the Bank Vic has got a 2 and 3 year fixed rate at 4.98 right now, P&I, which is cheap, I think, especially with this change in sort of sentiment as we've seen. So I'm not suggesting you fix all, but maybe thinking about fixing right now just for a couple of years is not a bad thing. And similarly with the investor lending as well, so we're looking at probably a 5.40 P&I variable rate. That's Bendigo Bank. Move Bank are a little bit cheaper right now, but mid-range is interest only about 5.60. So Mac Banker 5.65 and Bendigo 5.59. But a cheap fixed rate investment IO, again, Bank Vic, they're at 5.38 right now, which actually is a bit of a margin in that too. So I don't foresee interest rates going down. I think we're looking for a new sentiment change right now. So maybe that offers a bit of value just to lock in and get some cash flow certainty.
Yeah, sounds good. Now, what trends are standing out to you in the property market as we head further into 2026?
Good question. Well, I had another podcast. I kind of moonlighted from Boothy Bites, Jackie. I got to apologise, but we did the property coffee club today. Anyway, we're trying to get our partners a few more, I don't know, just some, like conversations with professionals outside of lending, because sometimes I'll become a bit boring, right? But anyway, so I chatted with a guy called Reese Marini, and he's part of the Allens Wargent Group, which I suppose Southeast Queensland and Newcastle Central Coast buyers agency business. Yeah, good guys. And certainly what they're seeing right now is that purchase price around that, $800 to $1 million is almost impossible to find. And in fact, the price increase for those properties has been seen at sort of 10-15% since sort of October time. So all of these government benefits which are given back to borrowers around this stamp duty exemption, government grants, lenders mortgage insurance exemption, etc., pretty much all it's done is go back into the capital value of the property, and therefore people are paying more. But there's less demand because affordability right now is quite good around that $1 million. The second part of the market which is attracted to that same price point is your property investors, because they're looking to borrow to invest. They're looking at properties at that same price, so it doesn't really burn their budget to do other things. And again, the demand in that marketplace across the nation is huge. So yeah, it's been really tough. Where I suppose the market is a little bit freer is that sort of $2.5-3 million property plus, and certainly affordability is tighter there. There's more people actually. Funnily enough, a lot of people who are a bit more mature, retirees in particular, they're selling their expensive properties and trying to downgrade and go into lower price properties to actually cash up and have a better lifestyle. But the demand for those properties, again, they're competing with first home buyers, investors, and your retirees. So it's just a complete mess in that space. So that's what Reese was telling me, which is a bit tough, yeah. But there's I suppose there's some green shoots in market. Melbourne has been a bit of a slower pace for a while, so I believe I've been given just as a few people are picking Melbourne as a right time on that property clock to purchase right now. And there's probably a few more properties down there which have got that price point in place. And Melbourne as a city is pretty beautiful city as well. So, and a growing city as well. So, the people who are struggling right now, if you want to go and buy in Perth, I think that property boom has gone crazy and gone. Adelaide similarly. Sydney is actually very expensive now. So again, we're seeing a few people sort of research outside of that, and Melbourne may be the pick for the next sort of 6-12 months.
Yeah. And so let's finish on the wrap up, what's happening at home, Lydian HQ. Let's dish the goss.
Yeah, so I mean, look, we've kicked off the year. So I think last year we talked about a bit of a diversification of our brand. So we've spoken about our Lydian private offer, which is great, and really enjoying the business growing and attracting partners in that specific high net wealth space. Our Lydian Life brand, we got that prepped up and ready to roll at the end of last year. We've got a great platform for people to review their life insurance, which is very similar to reviewing your interest rates. Also, there's competition in there with regards to types of cover, the exemptions for cover and things like that. So it's a really good thing to review ongoing. So Lydian Life is really complementing the services we provide to our clients and also to our partners as well. And then lastly, we're always looking for good people to join the Lydian crew. So most recently, we've got an engineer, a guy called Jorge. He's joined our western sort of suburbs, Sydney broker space. He's out in Dural, and he'll probably be tapping on all the school mums and dads to do loan reviews right now. So anyway, Jorge's rocking. Yeah, so just watch this space. So I think we're looking at more brokers and more partners and a bit of diversification of service as well.
Oh, sounds great. What a wrap up.
And Roxy's down in Melbourne doing his partner roadshow right now, so stay well clear.
The man's on a mission.
He is, totally. But he's gunning it. So, yeah, he's doing really good. Cool.
Good. Well, thank you so much, Boothy. Thanks, everyone, for watching.
Thank you. Ciao.
See you
Bye.
next time. Bye.